Good afternoon and welcome to our Spring Term Money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damian Pudner, Director of the IIMR, and today we are delighted to be hosting George Selgin. George is a Senior Fellow and Director Emeritus of the Center for Monetary and Financial Alternatives at the Cato Institute and Professor Emeritus of Economics at the University of Georgia. He is the author of numerous academic journal articles and books, including, but not limited to, The Theory of Free Banking, Rowan and Littlefield, 1998, Money, Free and Unfree, the Cato Institute, 2015, Less Than Zero, The Case for a Fall in Price Level in a Growing Economy, also the Cato Institute, 2018, Flawed, How a Misguided Fed Experiment Deepened and Prolonged the Great Recession, the Cato Institute 2018, and The Menace of Fiscal QE, also the Cato Institute 2019. He is also editor-in-chief and a regular contributor to the website Alt-M, Ideas for an Alternative Monetary Future. In fact, I should just say that George has a new book due for release in 2025 called False Dawn, The New Deal and the Promise of Recovery, 1933 to 1947. George holds a BA in Economics and Zoology from Drew University and a PhD in Economics from New York University. Today we will discuss free banking, after which we hope to allow time for a Q&A viewers online. And with that, I'll hand over to you, George.
Thank you, Damian, and thanks to the International Institute for Monetary Research for giving me this opportunity to talk about free banking. I want to start with a kind of disclaimer. A lot of people, a lot of economists included, seem to think that anyone who wants to talk about free banking also is determined to abolish the Fed or only talking about it as an alternative to the Fed, lock, stock, and barrel. Now, I'm not crazy about the Fed, but I think it's very important to recognize that talking about free banking is a way to understand how banking systems work, and including the way modern unfree banking systems work. It's a way to gain a better, deeper understanding of the forces that are at work in regulated as well as less regulated banking systems, and particularly what central banking does and doesn't do. The question of whether we can have a free banking system is quite separate from the question of whether it's worth talking about. An analogy that I'd like to make is with the theory of free trade. Of course, pristine free trade is also something we don't see anywhere, and we have to look at history for some examples that come relatively close or more close than others. But all trade theorists study free trade as a way to gain an understanding of some fundamentals, which allows them to better understand what tariffs and protectionism do and how they change things. So I see the study of free banking as similar to that. Now, what exactly do I mean by free banking? Well, the mention of free trade should give you some idea. Free banking doesn't mean that you don't pay for it. I know that's used, the term is used in the UK, especially in that way. But what we theorists mean when we talk about free banking is how banking works when there is no special regulation. There's regulation, all right, from competition, among other things, as we'll see. There's certainly laws of contract. There's certainly rules, but there's no special regulation applied to banks that might not be said to be applicable or might not be applied to most industries. One of the particular sorts of regulation that is absent from a free banking system concerns the issue of circulating currency, paper currency historically, which of course nowadays is almost exclusively provided by central banks or other government monetary authorities. But in free banking systems, it is supplied by ordinary commercial banks. along with various kinds of deposits that can serve as exchange media. So you have decentralized currency supply just in the same way that you have decentralized deposit banking. Now, of course, saying what free banking doesn't involve, that is how it is not regulated, doesn't itself allow you to have an understanding or a vision of a free banking system that you can theorize about. The way we've handled this among the free banking theorists is to concoct a sort of imaginary free banking system by thinking about what such a system would look like and how it would operate in the absence of the regulations that most systems have. I have a paper with Larry White, which is also the first chapter of my book on the theory of free banking, called The Evolution of a Free Banking System, where we reconstruct mentally, as it were, what a free banking system would look like and how it would operate. Of course, the chapter is informed by historical experience, but it doesn't depend on any specific historical episode. Now, since plural note issue, or having a lot of banks issue currency, is one of the more peculiar features of a free banking system, it is also what most of us have been particularly interested in studying. In the past, that is, if you go back 100 years, currency issuance by commercial banks was not that rare. And Kurt Schuler, in a survey of free banking, has mentioned some 60-odd episodes. In fact, most countries that have been particularly worth looking at, most countries have had plural note issue at some point in the past, whereas the concentration of currency issuing powers in a monopoly bank, that's a relatively modern development. Of course, some banks had monopoly privileges going way back, including the Bank of England, which had a monopoly by the early part of the 19th century. But in other cases, plural note issue survived until much later. But a lot of these cases also had other kinds of regulations that made them unfree. We'll talk about the U.S. system later, before the Fed, as an example of that. So there are a handful of systems, though, that come pretty close to the ideal type of free banking. And the ones that have been studied the most are those of Scotland and Canada. Scotland for roughly a century, ending in the middle of the 19th century. Canada from the time of the Dominion, which is 1870, to depending on how you look at it, World War I or the Great Depression, because they've moved away from free banking in stages. Now, what's interesting about those two examples is how their historical performance compared to that of their nearby neighboring banking systems. So we have the comparison of Scotland, the Scottish banking system, and the English banking system of the same era, and that of the Canadian banking system and the United States banking system of the same period. And the record is very clear. The Scottish system was much more stable and much more efficient, and gave rise to a lot more financial innovation than the English banking system at the same time. And that example is striking, among other reasons, because England had a central bank during the period in question. In the case of Canada and the United States, the facts are very similar. The Canadian system was remarkably stable and avoided all the crises to which the United States system was exposed at the same time. And in both of these cases, the countries involved, they shared the same basic currency. The British pound, which started out early started out as a silver standard in the early part of the 19th century and of course in the 17th century, then eventually became a gold unit. But from 1707 on, Scotland and England had unified systems with the same basic metallic standard. In Canada and the United States, it was the same thing, the exact same gold dollar. So you can't say, for example, that there were more crises in England and Wales than in Scotland because of the gold standard, because they shared the same standard, same thing in the United States. So you have two very clear facts, and no economic historians dispute this. You have more free banking systems that were stable, less free banking systems that were quite unstable. And the question is, how come? How come the systems that were less regulated and less centralized were more stable than the systems that were more regulated and more, in the case of England, certainly more centralized? The US is a special case. We'll see that it was decentralized, but not free. And we'll see exactly why. I'm going to argue that there were two key reasons for the stability of the Canadian and Scottish systems. And by the way, I don't mean in focusing on them to deny that there were other free banking systems that performed well. I could mention a few. The Swedish system was an example, and there were other episodes, some more or less long-lived. But the main things that I believe were responsible for the stability of freer banking systems were two. First, there was the disciplining effect of competition. And I'll explain exactly what I mean by that in a moment. But it's particularly important to stress here that the competition that was crucial was that between multiple note issuing banks with more or less equal privileges. And that's the sort of competition that's lacking in any monopolized or central banking system where one bank enjoys unique privileges of note issue. The other source of stability was a kind of negative source. There were no debilitating regulations. That is, these systems avoided regulations, including monopolization of currency, but not just that. They avoided regulations that were weakening, that made the other systems vulnerable to crises. And I'll talk about some examples of that. So let's start with competition in money supply. I'm going to make some assumptions about the basic arrangements that are important, or point out some features that are crucial here. First of all, as I mentioned before, the systems we're talking about operated on specie standards, gold or silver. I may talk more about gold because it was relevant for more of the history that I'm referring to, just to save time. That meant that all of the bank's IOUs, whether we're talking about deposit balances or the paper currency they issued, were redeemable or convertible into gold on demand. So just as you could go to your bank today and withdraw, if you're in England, Bank of England notes, in those days you had the right to go to a Scottish bank and with its paper notes and convert those into actual gold coin. In the United States, in Canada, of course, you had the same privilege for the paper Canadian dollars different banks issued. Oh, I should stress another feature that's very important is these banknotes of different banks are distinguishable. They're all denominated in common gold or silver units. In that sense, they're identical. A Canadian dollar from the Bank of Montreal was the same unit, represented the same amount of gold as a Canadian dollar from the Halifax Bank. But they were distinct in the sense that every bank just indicated on its notes that the note came from it. So they weren't copying each other's notes. And this is very important. Anyone who had a banknote, including a rival bank that had another bank's note, knew where it came from, knew who was responsible for converting it. The other thing that was important was that if a bank failed to honor its promise to redeem its notes, there were serious consequences. There were no agencies that would bail out the banks in these cases. Yes, they could get help from one another, but there was no government bailout. There were no prospects of bailouts from a government monetary authority or from a private privileged bank. All the banks had to sit in their own bottom, so to speak. In Scotland, there was a particular Scottish legal principle called summary diligence. Without going into it too much, it meant the minute a bank dishonored its note, it was in default, and it had to liquidate. That meant failure. This is very important because ultimately the disciplining mechanism that I'm going to emphasize here simply consists of the prospect of failing because a bank doesn't honor its promises. Now, that can happen in modern systems as well, but it turns out it's important here that it applies both to the failure to redeem currency on demand when asked, and similarly for deposits. We'll see how this requirement matters in a free banking system in a different way to a different degree than it does in a monopolistic system. The other factor that's important, of course, is interbank rivalry. Every bank in the free banking system wants to get its own currency held, its own paper IOUs, as it were, and is jealous of all the other banks. As far as every competing bank of issue is concerned, the rival bank's notes in circulation are taking up space that its own IOUs might be taking up instead. And of course, the more IOUs a bank has outstanding, the more savings it is intermediating, because every one of those IOUs represents a sort of loan to it that it can be called at any time or redeemed. But in the meantime, the bank is borrowing money, which it's using to finance profitable loans and other investments. Okay, so what does this mean? It means that there's a tendency, which ultimately becomes institutionalized, for banks, rival note-issuing banks in a free banking system, to actively gather up rival banks' notes, return them to those notes directly or through a central clearinghouse, which is an institution set up by the banks to expedite these exchanges, and ask for payment. And what eventually happened in Scotland and Canada and elsewhere was the establishment of formal arrangements for active redemption of notes, as well as checks and other items, through a central clearinghouse or through side exchanges directly between banks. And these clearings and settlements, clearing is just sending the currency back to its issuers. Settlement is settlement in gold or silver of any outstanding amount. They would happen once a day, eventually once a day, at the end of the business day. And any bank that returned items from other banks in excess of what the other banks returned to it on a given day would have the balance settled by the banks that owed more in specie. They would have to transfer that much specie to the bank that had a net credit in its favor after canceling out all the overlapping items. Now, what did this end up meaning in practice? It meant that banks had to be very careful about how much lending they did. They had to exercise care in extending credit, in creating deposits, or in issuing notes, because if they overdid it, if they were too generous, they would lose out at the end of a clearing session and they would have to fork over gold. And if they had to fork over too much, more than they had on hand, they could go bust. So there's real discipline here. I'll explain how creating a monopoly allows it to evade this discipline, at least in the short run, and how that screws things up in a moment. So you have all these banks actively competing with each other, collecting each other's notes. By the way, in the early days of the Scottish system, they would do this quite aggressively. some banks would go out and have people buy up rival banks' notes so that they could stockpile them and then spring them all at once on the bank that they were trying to make go broke. But that was an old arrangement, and eventually the bankers found it was better to just cooperate, not by holding on to each other's notes, but by just returning them every day in the course of business. So banks wouldn't be out to kill rival banks, but they would still be disciplining them through the ordinary course of exchange. So what we have here is an important source of discipline. I'm just going to give an example that's an exception that proves the rule of how things worked. And this is a famous example. It was an early Scottish banking system crisis, and at the center of it was the Ayr Bank. Now, this took place in 1772, and what happened was the Ayr Bank, so-called, because it was located in the town of Ayr, its actual name was longer, but everybody called it the Ayr Bank. That's AYR. It was a new bank, but it decided it wanted to be a big bank. In fact, it decided it wanted to be the biggest bank around, and quickly. So the Ayr Bank lent very aggressively. And now the other banks have been in the business a while, and they kind of knew the score, at least the better ones, the more well-established ones. And they said, oh, this isn't going to end well. Well, the Ayr Bank, sure enough, started hemorrhaging specie reserves because, having lent so generously, it found that at the end of every day, more items were being returned to it for payment, because when the bank is making more loans, it's creating more deposits or issuing more notes to the borrowers. Those found their way into rival banks. And when they started sending them back, the Ayr Bank found it had to come up with reserves. In order to avoid going bust right away, the Ayr Bank tried to save itself by borrowing heavily in order to, it was essentially borrowing the stuff that it had, the gold that it had to pay to settle with other banks. But of course, it wasn't profitable for it to keep doing that. Finally, the Ayr Bank failed, brought down several other Scottish banks, but not the better ones, not the bigger ones. And this was a big crisis. But it showed that the disciplining mechanism of adverse clearings and settlements, it worked. And for almost a century after the Ayr Bank crisis, Scotland went through this long period of great economic stability. One good lesson in summary diligence seems to have made a big difference. I'm going to say one more thing about this because people bring it up. They say, well, what if all the banks try to expand together? If they do so in unison, then sure, they'll get more notes returned to them, but they'll also be returning more of other banks' notes. Since everything will cancel out, then really the system as a whole could then go hog wild. Well, in theory, that sounds like it's true, but it's actually not. And the reason why, I've written a paper about this you can read, about in concert overexpansion, is because there's always going to be an element of randomness in payments. And that prevents the banks from perfectly coordinating their expansion, even if they tried. And of course, they really have to try. And as a result, usually some banks are going to find that they are, in fact, being hit by adverse clearings that threaten to cause them to default. And that's going to cause them to stop cooperating if that's what they've been trying to do. And that's going to pull the whole system back. A good analogy here is with the three-legged race. If you've ever been in a three-legged race, you know what I mean. You tie two people's legs together and have them try to run. Well, imagine doing that with a dozen people or 30 people. There were about that many banks in Scotland during the height of the free banking era. And they're all trying to run away. But if any of them missteps, they all come tumbling down. And that's why in concert expansion doesn't work and isn't something that it makes sense for banks to even try. So the system's tied down, and that's why we can explain or understand that there wasn't a lot of overextension of credit. Doesn't mean that there was any shortage of credit. This is also important because if the public needed to hold more money, if its actual demand for balances of Scottish banknotes or deposits grew, then those notes and deposits wouldn't tend to be returned to their sources for redemption. So banks could expand their balance sheets more if they had more people out there who were willing to hold on to their IOUs. So when expansion was consistent with growth in the public's demand for real money balances, then it was profitable for the banks to take part in it. It was only when the people didn't want to hold more money balances, so the notes would come back to the banks, excuse me, that that they would find that they'd expanded to the safe limits of expansion and couldn't press much further. All right. Now, an interesting question to ask at this point is, what does this do to the reserve ratios of the banks? You might think that all this strict discipline of adverse clearings and reserve losses and summary diligence would have meant that these Scottish banks would have held very high reserve ratios to keep out of trouble, to keep from failing. But that isn't what happened. In fact, the system was remarkably stable, and this was true of the Canadian system as well. At the height of the free banking era, let's say around 1830, your average Scottish bank only held about 1 to 2% specie, that is gold or silver reserves. That's it. That's because the public's demand for the public's preference for the Scottish bank's notes and deposits compared to gold was very high after they had established their reliability and safety. So Scottish people didn't want to hold gold guineas or sovereigns later on. They preferred to have a Scottish banknote. And the system gained in efficiency gradually over time so that the amount of gold or silver needed for the net settlements was very, very small. But at the margin, a bank that issued too much would get in trouble. So even though the reserve ratios were very, very low, the system was sound and the system was safe. They were low because the banks had discovered how low they could go safely, and they could not expand over generously, even though their reserve ratios were low, precisely because it wouldn't have taken much over expansion for any of them to run out. So, very efficient system. This, by the way, is also answering an issue raised by some Austrian economists who are very critical of fractional reserve banking. You'll often hear them say, well, if banks were totally free, they'd have to hold very high reserves, and fractional reserve banking probably wouldn't take place to any great extent. That's simply historically false. The fact is that the freest banking systems, the ones where the disciplinary forces of the market were working best, actually got by with very small reserve ratios. Okay, I've got to hurry up because I've got a lot more to say. I want to talk about the consequences of monopoly, and particularly monopoly of currency, because that's the monopoly that ultimately shaped up into having central banks. Even a partial monopoly can have serious consequences. The Bank of England was established in 1694. Its monopoly privileges were very limited at first, though real enough, and they grew over time. By the middle of before the middle of the 19th century, the Bank of England's privileges gave it a complete monopoly of currency in England and in Wales, not in Scotland. Scotland continued and continues today to have some commercial banks that issue currency. So the Bank of England had a gradually acquired monopoly of currency. What does such a monopoly do? Well, you have to remember that banknotes paper currency was very popular. It's more convenient than gold or silver coins. And when you have a system where one bank has the privilege of issuing the stuff, if it's at all considered reliable, the other banks are going to need that currency to use themselves to please their own customers, since they can't issue their own. So what happened in England was that all the other banks, and by the way, until 1826, the Bank of England was the only joint stock bank, or we could say corporation. All other banks in England up to that time could only have 6 partners or fewer. So they were very small banks and very weak, entirely owing to a legal impediment to becoming bigger, entirely legislative. This is a good example of another kind of government interference that caused weakness in a banking system. So all the so-called country banks of England would hold on to Bank of England notes to have paper currency for their own customers and not return them actively to the Bank of England for payment in gold, which was not as immediately useful for their own reserves. Bottom line, Bank of England notes became a reserve medium treated like gold in the English and Welsh banking systems, whereas in Scotland, the only true reserve medium, the only thing treated like that was specie itself. Well, what did that do to the Bank of England? And remember now, the Bank of England is still obliged to redeem its own notes in gold and silver. The problem is that under this arrangement, it isn't actively presented with its own notes in the course of everyday business for redemption. The redemption is potential redemption, but it isn't tested all the time. It isn't taken advantage of all the time by rival banks. And it's rival banks that are otherwise most inclined to take advantage of redemption and thereby discipline each other. So the Bank of England is escaping from this discipline. At least in the short run, it's escaping. It can expand credit more of its currency goes out, but it stays out because the other banks treat it as reserves. And having more reserves, why? They feel they can expand more. So what happens is the monopoly bank, here the Bank of England, turns into a kind of Pied Piper of credit. It is able to expand credit and lead on the whole system in an expansion instead of being disciplined by the rest of the banks. And this was the key to English banking crises in the 19th century, especially during the gold standard era. Why? Because ultimately, by issuing too much credit, the Bank of England would cause British prices to rise and also would cause interest rates in Britain to be artificially low for a time compared to the rest of the world, where there's also a gold standard, at least after 1870. Now, as British prices rise and interest rates fall, at some point, that's going to trigger an imbalance of payments. That is, you might not have the Bank of England might not worry that it's going to have to dish out gold to settle with rival banks. But once the exchanges turn against it, lo and behold, gold's going to end up flowing from it anyway, not to other English banks, but abroad. And then it's going to have to cut back. It's a long run adjustment, but it's like running out on a long leash and getting yanked violently back. The result is, because things have gotten so far out of line, when the correction, the long run international payments correction kicks in, it does so violently. And that was the key. This is the key to classical era banking crises in England and Wales. You'd have excess expansion of credit, mostly fueled by the Bank of England, and then you'd have a sudden reaction by the Bank of England. But the weak banks were the ones that would mostly fail. The Bank of England itself would it might suspend, but in any case, it brought down more other banks rather than itself. It would tighten up just enough to save itself at the last minute, and a zillion 6 partner banks would fail. Now, I want to talk about America a little bit, but I should briefly explain that these crises I've just accounted for in 1825, 1847, 1837, 1866, 1890, they did not have their counterparts in Scotland. 1826, with a huge crisis in England. In Scotland, everything's calm. If you look at my Twitter page and look at the background, you see a cartoon done at the time that compares things in Scotland and England. It was notorious that Scotland was not having these crises. But since England was having them, it had to do something about it. Finally, the Bank of England started to act more prudently in a way, and not react in a way that would bring down so many other banks. This was the beginning of the lender of last resort doctrine. In 1866, that was a good example. The bank decided to try to not make things worse than necessary by keeping the flow of credit going internally, despite the threat to its own reserves. This developed and was formalized as the classical lender of last resort doctrine, particularly in a book called Lombard Street by Walter Bagehot, which explained what had happened and how the bank had become conscious of this problem, which it was creating, by the way, and how that should become the basis of its future activities in response to crises. In other words, it needed to recognize this in a more formal way, that it had a lender of last resort responsibility. Now, everybody, all the central bankers, when they mention Bagehot's book, they say, see, Bagehot said we need to have a lender of last resort. So here we are. See, we're doing Bagehot's thing. Bagehot didn't say that. What Bagehot said that England, the Bank of England, given that it existed, needed to act that way. But he also very clearly said, this isn't natural. England doesn't have a natural banking system. If it had a natural banking system where no bank had privileges in the first place, then we wouldn't have this problem. So we wouldn't need a lender of last resort. Very important. If any central banker tells you that Bagehot wrote a book saying why we need central banks, he's wrong. Okay. Let's turn around a little bit and talk about Canada and the United States for a few minutes. I'm not going to say a lot about Canada because the principles of operation there were similar to the ones that apply to the Scottish case. I will say there were some important differences. Entry into Canadian banking was much more limited than it was in Scotland. So there was a departure for free banking. It became especially more limited in the late 19th and 20th century. So it was, again, not a pristine free banking system, but it was darn close. Oh, and it shared another feature with Scottish banking that I didn't mention that's very important, and that all banks tend to take advantage of, or most of them will if they're free enough, which is branching, of having widespread branch offices. We take that for granted in the United States even today, but it wasn't so always. In fact, we mostly had one unit banks with only one office for most of our banking history. Now, Canada, the United States suffered severe crises in 1884, 1893, 1907. That's just the gold standard era ones. And again, Canada pretty much evaded any of the problems. There was hardly a ripple in most of them. How come? Now, this isn't a case where you could say, well, you see, there was a central bank in the United States causing problems that in the long run created crises, as happened in England, because the Fed didn't exist until 1913. So both Canada and the US had decentralized currency systems. However, that's where the similarities ended, whereas the Canadian system was mostly free. In the United States, there were all kinds of restrictions on banking. And the point here is there's more than one way for governments to screw up their banking systems and make them unstable and crisis prone. In particular, there were two legal restrictions that were very important in the United States that were absent in the Canadian decentralized system. One was what I mentioned briefly a minute ago. Most banks couldn't have any branches. So you had tens of thousands of crummy little banks mostly that could they could all issue currency. I'll talk about the restrictions on that. But it's a ridiculously large number of banks and there are no branches, which means it's harder for them to redeem each other's notes. It's actually a lot more costly. If you're a one-office bank in San Francisco and you got to redeem a note that somehow got there from New York, you got to send it all the way back to New York. The other thing were restrictions on banks' ability to issue notes that were highly debilitating, special laws that said when they could issue notes, how many, or in some cases denied them the power to issue notes at all. And these restrictions, they were the key to U.S. crises before the Fed, and to some extent afterwards. Prior to the Civil War, I'm only going to go on for a couple more minutes. Prior to the Civil War, after the demise of the second bank in the United States, we had complete decentralization, but you had these banks called free banks, very confusing, the so-called free banking era in the United States. Well, that was their name in law, but the reality was they weren't free at all. None of the so-called free banks could branch, none of them. Couldn't have a single branch anywhere. So they were all small and undiversified, and it's costly to redeem their notes. Second point is all of them had very strict rules on how they could issue currency. And most of those rules told them they had to buy specific assets to back that currency. And in many cases, not all, the assets they were forced by law to buy turned out to be junk. And this junkiness of the legally required assets for backing note issue was the main cause of failures of the free banks. And some of the systems had notorious numbers of failures, all traceable to government intervention. The wildcat banks, the notorious wildcat banks, were of this sort. They were a subcategory of the worst of the so-called free banks of the antebellum era. After the Civil War, during the Civil War, there were many regulations that changed things, including a tax that put all state-chartered banks out of the business of issuing currency. So that's a legal restriction, but created a new banking system with a similar requirement to that of some of the free banking systems. The national banks had to back their notes with, guess what? Federal government bonds. Why? To help pay for the Civil War. After the war, the government started retiring its debt, and they couldn't issue enough currency to meet the demands of the public. And that was a crucial reason for the crises of 1884, 1893, 1907, the so-called inelastic currency problem. And that's what the Fed was set up to solve. I'm not going to talk about the founding of the Fed. I could tell you about how it really turned out to be a very poor solution to the problems of the U.S. currency system beforehand, but I want to have some time for questions. Thank you all very much.
Thank you, George. A very detailed, in-depth and interesting discussion there on free banking, which is very little understood really in today's modern economy. I have to say that a lot of the questions I have, you've already kind of mentioned and answered in your presentation, a lot really centering on the overissuance of currency and the lender of last resort issues. I mean, what happens, what mechanisms will be put in place as a lender of last resort without a central bank? Who picks up the bill, basically? Yeah. Who's responsible for that, and how you would legislate for that? So those are a lot of questions on that. A couple of questions on if digital currencies and blockchain would impact the feasibility and implementation of free banking. Given the prevalent use of cash, specifically in dollarized economies like Ecuador, do you think dollarized economies could benefit from plural note issue by private banks?
I'll answer the last question first because I have an article answering it, and so I just have to sum it up. The article is called something like Free Banking, an Alternative to Currency Boards and Dollarization. And basically the answer is yes, because with dollarization, of course, there's a cost to dollarizing. Everybody's using Federal Reserve dollars, so they're actually lending to the Fed, and they're allowing the U.S. to earn seigniorage from their savings. That is to lend to have access to it and use it, so it can't get invested locally. If, for example, Argentina were to dollarize again, or if Ecuador were to allow it, they could have commercial banks issue paper notes, their own notes, denominated in dollars, but then those dollars would be used to fund local loans, and this would be better for the economies in question. Now, of course, you want to have your banking system be sound in other ways, like the Scottish system and the Canadian system. So you don't want any old banks issuing their own notes. But if you have other good bank regulations, private note issue is a good supplement to dollarization, a better way to dollarize. Pardon me, to dollarize. There was another a question, a remark about, oh yes, lender of last resort. There are other ways for private banks to deal with crises, because sometimes they might face crises that that are not any fault of their own. It's conceivable that people could panic and just start a run when it's not really a problem bank. It doesn't happen as often as people think, including some Nobel Prize winners. But there's such a thing as a suspension of payments, where the bank contractually arranges, says, in certain circumstances, we reserve the right to suspend redemption of our notes for a limited period of time, and we're going to pay you interest in the meantime if we do that. This is like an emergency escape clause. Scottish banks use such clauses called option clauses for a time in their history, and by using these clauses, they could get people to not stage runs when there's no good reason for it. And studies have shown, including another article I've written on bank suspension of convertibility, that if the contracts are correctly designed, they can rule out bad runs that are worth ruling out, but not otherwise do any harm. And so that's a very good contractual alternative to relying on a central lender of last resort.
Yeah, no, I'd agree with that. A question here on could free bank, I mean, a couple of questions on this, but free banking lead to increased currency competition on international markets? And a couple of people have mentioned Argentina as an example. If they had a free banking system there, how would you give confidence to foreign investors in the system? And could the money be, or how could you prevent the money being taken out and deposited elsewhere in foreign banks? So
I'm not sure how to answer that question. I mean, free banking doesn't really doesn't really alter the attractiveness of particular currencies. So if you had free banking today in the United States with dollars, you'd still have a dollar standard that's managed by the Fed. This is very important. I said at the beginning of the lecture that I'm not here to make a pitch for going back to free banking or for embracing free banking today. But one reason for that is it's hard. Once you have fiat money issuing central banks instead of a specie standard, your standard money is what they issue, nothing else. So what are banks going to do with their freedom? You can make ordinary banks as free as you like. You're still going to have a dollar that's issued by the Fed as your fundamental base currency. And therefore, free banking isn't going to change the fundamental attractiveness of the dollar. Free banking doesn't make dollar inflation go away. It just prevents the commercial banks from being part of the problem, if you know what I mean. So the central bank can still is still ultimately responsible for how attractive a currency is internationally. It's not, of course, the only thing that matters. So I don't see a big change in foreign currency competition, if I understand what that is meant to refer to here, being a result of free banking. I think that if it had any effect, it would strengthen the demand for any currency that it was applied to, because it would create a more stable system around it. So that currency would be less prone to crises. There'd be less need for lender of last resort activity. You wouldn't have to have a central bank with, an $8 trillion balance sheet because of rescuing the monetary system every now and then. So I think that if free banking had any effect, it would strengthen currencies that were associated with it. I forgot to answer a question about digital currency,
yes,
Damian.
digital
Somebody
currencies.
raised that. And I'll just say that there is a connection. I see stable coins as the closest digital equivalent to the old competitive banknotes of the past. And The problem is, I'll speak only here of US dollar stable coins, which are the most important quantitatively so far, that none of the issuers of stable US dollar stable coins, none of them are ordinary banks, first of all, and none of them are able to compete on an even playing field with ordinary US banks, particularly by accessing the clearing and redemption system that's so important, as our theory, as the theory I covered explained. Unfortunately, among their other monopolizing activities, central banks, including the Fed, have often taken over the clearing and settlement business, or big parts of it. So now that disciplinary system or arrangement is something that the Fed controls, and it controls who gets to play and take part in it, who gets to be a member, by determining who can keep accounts on the Fed's books, master accounts. Well, the Fed has, in several recent decisions, or by not deciding at all, has refused to let stablecoin issuers or any firm that looked like it might issue stablecoins be part of the Federal Reserve overseen clearing and settlement system. So the irony here is, in the name of avoiding dangerous stablecoins and allowing them to infect our not so good banking system, the Fed is preventing them from being part of the very arrangement that would discipline them the most and make them as safe as they can be. So that's where we're stuck at. The Bank of England has had a much more indulgent relationship to fintechs, including potential stablecoin issuers, but it's still too early to say just how indulgent it's going to be. Okay. By the way, these stablecoins could be very good rivals, and ultimately, I believe, would be superior to central bank digital currencies. That is, they could do whatever those currencies might do and not pose the problems of privacy and other issues that central bank digital currencies pose.
Could free banking exacerbate economic inequality, as banks would focus on wealthier clients to attract large deposits and investments?
I don't believe it. I think the one thing you really want to avoid, if you want to not have inequality get worse, is financial crises. That's got to be number one on the list. Rich people suffer during those crises, but the poor tend to suffer disproportionately. So I think that having a banking system that doesn't collapse every now and then has to be the first priority, both if you're interested in preserving or preserving equality or minimizing inequality. Everything else is small in comparison. And let's be clear that in a free banking system, we have freedom, complete freedom of entry for different kinds of banking firms catering to different clients. So we're getting away from a system where there might be a tendency to cater for all banks to cater only to certain types. The Canadian system, because of its limited entry, has been accused of catering to the big guys and all that. I don't know how true that is. The studies are mixed at best. There was competition in the system as far as pricing arrangements go, but in an honest-to-gosh free banking system, you're going to have a lot of varieties of banking services of many different types of banks. I know that the Scottish banking system was great for banking people. We have a problem of underbanked people and unbanked people, but the Scottish banks really, they pushed the banking of banking to limits never seen in any other system. You could open accounts with what were then very small amounts. They dealt with a lot of small depositors, and they helped them accumulate their savings in a way that wasn't possible for them through any other investments available at the time. So I wish people would look more into this history of Scottish banking people who would otherwise have been underbanked. I think they'll find it did a pretty darn good job.
Right. Last question then, although we do have a lot more, but I might have to put a separate email to you. Last question. Do you think, or what are the chances of going back to a non-centralized banking system? And there's references to the size of the US debt and spiraling debt. I mean, do you think that there's any chance that we go back, or any increased discussion on it?
I think the chances are very low. The basic problem is that to go back to the sort of system with absolutely no central monetary authority and no fiat money means because fiat money, you can't have fiat money without a central issuer that you hope you can regulate, because it's not going to be subject to any natural limiting forces. But if you to get away from that, to have banks not relying on such money, they have to be back on a specie standard or something like that. It could be a Bitcoin standard, by the way. But I am afraid I'm very doubtful of the ability of gold or silver or Bitcoin or anything taking over and being reestablished either through official channels or spontaneously from established fiat monies because of network problems and reliability and all that. A spontaneous switch to a gold standard runs into the network effects problem. Basically, it's very costly. Nobody wants to join a network, a payments network that hardly anyone else belongs to. Very difficult to overcome that. It can happen, but it's a slow process. The easiest way to get a gold standard would be to have the government officially embrace it and say, okay, from now on, Federal Reserve dollars are once again going to be convertible into this much gold. And we can pretend for the sake of argument that there's this much that's going to work just fine, smooth transition, everything. But there's a hitch. It's a huge hitch. The confidence genie, when it comes to central banks maintaining specie standards, left the bottle in the 30s. and you can't stuff it back in. So what would people do if they had now a put option to exercise, right? You're holding a Federal Reserve note, you can trade it for gold. What are the odds that the value of the note, that is, what are the odds that one day, if you keep holding this note, you're going to be able to get more gold than the Fed presently promises you? I'd say that's probably about zero.
Yeah.
What are the odds that you won't be able to get the gold it's promising you now, right, one day? Probably above zero. What's the prudent thing to do? Get the gold now.
I agree.
And so you've got a gold standard for a day.
Yeah.
And that's
There was a question on network effects, but to say we're not going to go into it now. We've run out of time. A lot of people saying this is going to be the renaissance of free banking with Bitcoin gaining prominence. I mean, I don't know, but
a Bitcoin probably is the best bet. Gold, I think, is less likely, but people can debate that. But it's still a big uphill battle. And it should be said that many Bitcoiners can't stand the idea of having banks with Bitcoin, even though Hal Finney thought it would be a good idea. Many of them don't. They don't want to see that. So it's a kind of, banking is a kind of second layer technology. It's just old fashioned. I actually think it could work pretty well in the right circumstances. But there are a lot of Bitcoiners who are kind of Bitcoin maxi types who really wouldn't want to see Bitcoin banking, even if it might happen. And so, unless they get on board, that could also interfere with the prospects of it taking off.
George, you've been excellent. Thank you very much for your time. We've used up the full hour, so really do appreciate everything you've done for us today. And with that, I wish you all a wonderful afternoon. Thank you very much.
Thank you, Damian, and thank you, everybody, for attending.
Thank you.